The storm desk. Read the storm, book the roofs. Same hail, same zip code, same afternoon. One stone field crosses a house and a two-tenant strip center on the same street. You run them the same way, because hail is hail, right? Then the strip stalls for 2 months, and the house closes in 3 weeks, and you can't tell why. By the end of this, you'll know the 5 places a commercial storm claim splits hard from a residential one, and where your pitch has to change. The roof damage is rarely the hard part. The file is. Start with the roofs, because the systems are not the same. A house is mostly steep slope, asphalt shingle, metal, tile. Damage announces itself. Missing shingles, creased tabs, a stain on a bedroom ceiling. A commercial roof is mostly low-slope membrane. TPO, EPDM, modified bitumen built up. That means a flat or near-flat roof with a sheet membrane instead of shingles. Damage there is punctures, open seams, displaced edge metal, and wet insulation hiding under a surface that still sheds rain. Different roof, different evidence. So the pitch can't be the same. Difference 1. A commercial claim reaches far past the roof. On a house, the file is contained. Dwelling, the stuff inside, somewhere to stay if it's unlivable. The carrier asks one question. Is the roof covered? And what's the fix? A commercial file asks a dozen at once. Business personal property, inventory, tenant improvements, and the income the business loses while the roof is open. Business interruption coverage pays for losses during suspended operations after covered physical damage. A leaking warehouse isn't just a membrane repair. It's spoiled product and stop revenue. Document the roof. Never promise the income. There's an edge case that stalls files for weeks. Who actually owns the loss? Commercial roofs sit under leases. In a triple net lease, the tenant may carry the roof or the contents. In a gross lease, the landlord handles the structure. Get that wrong and 2 parties point at each other while the roof keeps leaking. So your intake changes. Ask who owns the building, who operates inside, who can authorize work, and who signs. That's not your call on coverage. It just keeps you from contracting with someone who can't approve it. Difference 2. And this is where the money goes. Both sides turn on the same 2 words. Replacement cost pays to fix the roof without subtracting for age. Actual cash value pays the depreciated number. On an older roof, that gap is the whole settlement. And here's the hidden trigger. Many carriers cover a roof at replacement cost, only up to a threshold age, often somewhere in the 10 to 15 year range, then switch it to actual cash value, or decline it. 2 buildings, identical hail, wildly different checks. Age decides it, not how bad it looks. Now the deductible flips on you. A house usually has a flat dollar deductible, $1,000, $2,500, $5,000. A commercial wind and hail deductible is usually a percentage, and it rides on the whole insured value of the building. Industry guidance puts those commonly between 1 and 5%. Picture a building insured for $2 million. A 2% wind deductible is $40,000 the owner eats before the policy pays $1. On a house, the deductible is a line item. On a commercial roof, it can decide whether the claim is worth filing at all. 2 more value traps live only on the commercial side. First, the coinsurance clause. That's a policy term requiring the owner to insure the building to a set share of replacement cost, often 80 to 100%. Insure it for less, and the carrier penalizes even a partial loss. A covered roof, real damage, still a short check. Second, the cosmetic damage exclusion. That lets a carrier decline damage that affects looks but not function. Hail dents on metal coping that don't let water in. Whether either applies is the carrier's call, not yours. Difference 3. A commercial claim has more people who can say no. A house has a short chain. A homeowner, maybe a spouse, maybe a mortgage company. A single commercial re-roof can pull in a facility manager, a property manager, tenants, the owner, a lender, a broker, a risk manager, and corporate approval. Everyone can slow the file. Several can stop it. The trap is mistaking activity for authority. The person who walks the roof and runs the show is often not the one who can sign. Get the signer in writing before a crew rolls. Tenants change the whole job, and a house almost never has them. A re-roof over an occupied medical suite can't rain debris into a sterile room. A grocery store won't close produce, so you can stage over it. The roof scope might be simple. The choreography around the tenants is not. So one project log holds it together. Who asked for what you sent, who approved which change. When a request touches schedule, safety, access, or scope, confirm it in writing first. Difference 4. Commercial files run longer and demand deeper paper. Part of it is hidden damage. A membrane roof can look intact from above and be soaked underneath. Hail opens a seam, water spreads sideways through the insulation, and the wet area runs far past the entry point. On a house, water tells on itself with a sealing stain. On a flat roof, saturated insulation hides for months, corroding the deck while the surface still sheds rain. That's why commercial work uses tools a house never sees: infrared scans, moisture surveys, core cuts. Let qualified testing define the wet area. The paper goes deeper too, and safety is part of it. A house file needs photos, a scope, a permit, completion records. A commercial file needs all that, plus daily production logs, subcontractor insurance certificates, material tickets, and a manufacturer warranty package. And the safety record is part of the claim's credibility. OSHA's fall protection standard sets the requirements for working at height in construction, and your daily safety notes are evidence the work was done to standard. Build a packet so someone who never climbed the roof can read it. Difference 5, and it's the one that ends careers. The contractor's claim handling line pulls harder on commercial because the dollars are bigger. Here's a line. You document what you saw, what's needed, what it costs, what tear-off revealed. You do not advocate coverage on a job you're also building. Many states say it plain. A roofer cannot act as a public adjuster, advertise to adjust a claim, or waive a deductible on work it's doing. Say this: with your written okay, we'll send the photos to your adjuster, not, we'll get this approved. One gray zone tempts everyone: code upgrades. When a roof gets replaced, code can require work the old roof never had. Full tear-off where a recover is no longer allowed, updated edge metal, a better deck. But whether the policy pays for those upgrades depends on ordinance or law coverage, a policy term that may pay for code-required work. That's a coverage question for the carrier and the owner, so state the code requirement as a factual scope item and point the owner to the carrier. State the code. Never promise the payment. Here's where the pitch actually changes and where Roof Predict fits. On both files, age decides the money, replacement cost or actual cash value, deductible tier, eligibility. So walk in knowing it. Roof Predict pairs an estimated roof age range with storm physics modeled per individual home, scoring which roofs a real storm most plausibly wore out, so you know roughly where a building sits against those underwriting thresholds. It does not inspect, diagnose damage, or decide coverage. Roof age is a planning range, not an exact date. The list opens the conversation. The inspection earns the job. Close the loop. Same hail, 2 files, 5 splits. A commercial claim reaches past the roof into income and tenants. Value and deductibles bite harder with percentage deductibles and coinsurance. More people can say no. The paper runs deeper, and the claim handling line is stricter where the dollars are bigger. Run 2 intakes, not 1. Document conditions, write honest scopes, and stay in your lane. The insurer decides coverage. The owner owns the claim. The roof is the easy part. Win the file.